Devina Mehra is now joining us. She's the market master for the day, founder, chairperson, and managing director at First Global. Devina, good morning. Great to have you with us here on the program. Prashant this side. It's always a pleasure. Devina, markets have done phenomenally well. Nifty is up 12% from the 4th of June close, the election day. Mid caps and small caps even better. And now we get into the budget. And we also are, of course, not hearing, but the SEBI chief has made it very clear that on the F&O side, there are rules and regulations coming to tighten it. Where do we find ourselves in terms of markets? I'm talking slightly near term, not very long term, but not very short term as well, but shorter term. Devina.
Good morning, Prashant. A very short term is not something that I look at all, and even reasonably short term is not where my focus is. So, as I have spoken earlier on your channel as well, that on a 1-2 year basis, I am not negative on the market, and primarily because you had a whole decade of below market returns. 2010-20, that decade was so far below market expected market returns of 15-16%. It wasn't even 9%. It was pretty close to the FD rate for a whole decade. So 100 rupees in 10 years became only 230 rupees. And which is very different from what happened in the other decades. Of course, the outlier was the 1980s decade when 100 rupees became 700. So that's what gave you the room to grow. So, the way we have done it is that we are fully invested in our PMS, but we are partly hedged. Before the elections, we were fully hedged. Now also we are about 50% hedged to take care of any interim volatility, but I'm not negative on the markets. We just finished our rebalance last week. We do a quarterly base zero rebalance. So there have been changes in the portfolio, but we are not negative on markets as a whole. But as I have warned again many times, be very, very careful on the small and micro caps. So in our portfolios also, while we normally used to have about maybe 14-15% investment in stocks between 1,000 to 5,000 crore market cap. Now we are down to, I think, 6% or thereabouts. So that's because that's an area which you cannot manage risk effectively, because there are two tools primarily of risk management. One is stop losses, and stop losses don't work in small caps. When they go down, it's circuit down every day. And the only other hedge you can use, which is liquid, is a Nifty put, which again does not move in sync with the small cap. So that's where a lot of people watching this may have made a lot of money. Now is the time to go into a steadier portfolio. That would be my advice.
Okay, Devina, hi. Always great speaking with you, and good to see you this morning in your bright attire, brightening our mood for sure. But is there anything in the budget, Devina, that can change the course of the market? I know every time we speak about it because that's our job, but generally budgets don't really affect the texture of the market in the near to medium term. Do you think this budget would be any different?
I don't think so. Of course, there can be a macro change, like there can be a change in something to do with taxation, for example, either direct or indirect, which affects things across the board. That's one thing, but I don't think there will be a change in corporate tax this time. That's not what I'm expecting at all. So probably not. If there's a change on the personal income tax side, it boosts consumption, which definitely needs a boost. We've had very poor consumption growth numbers. Other than that, if there is specific changes in specific industries that, for example, there are industries where the GST is higher than 18%. If, let us say, two-wheelers, it comes down or something like that, that can impact directly that industry. But other than that, I do not see a budget to be a great event, and it should not be. In most countries, budget is not the event it is in India.
All right. Hi, Devina. Good morning and good to hear your thoughts. Devina, the last time we chatted, you were telling us that IT could bottom out at some time during this year. It seems the street is calling for that, going by the numbers that we had. How are you all placed on tech?
Yes, so IT is where we were slightly overweight going into this rebalance, and now we are a little more overweight. Yes, so our systems are showing that it has probably bottomed out. And the other thing which I had spoken about was that whether industrials and capital goods, that segment will top out. So that signal has not come. So we've been overweight on that sector, as I have said earlier, also since October 21. So it's getting close to 3 years. We are no longer, of course, very highly overweight, but we continue to be a little overweight. And of course, there have been some changes in stocks in that sector. But we still remain somewhat overweight there too.
Okay, you're a little wary of some banks as well, and that was the reason why you were not going overweight on banks, though consensus was saying that banks are in for a good run. That's not really played out. Now, how are you all positioned on the banking names, going by the numbers that we have had and the commentary as well that's coming in?
So, I mean, on banks, if you look at 4 years from 2020 onwards, banks have underperformed every single year barring 2022. Every single year. All other 3 years, banks, you look at Bank Nifty versus Nifty, Bank Nifty was a huge underperformer in spite of the run in the PSU banks. And as I have said plenty of times, that I am a nervous investor in non-lenders. We remain underweight banks, though. I mean, I would think that given a long stretch of underperformance, probably that, that grave underperformance period might be a little behind you. This time, the changes we have made, while our overall weight in banking has not changed much, we have moved out of some PSU banks and added some private sector banks. So that's a change. Interestingly, this time our systems did not like all the non-lending financials that we were holding, the asset management companies, the stock exchanges, and anything related to the market. It downgraded every single one. So we are more or less out of that segment. So that was an interesting thing in this rebalance.
Devina, so one thing which you've pretty clear about is that one should rebalance the portfolio if not one has already not done it. Made a lot of money in mid caps, small caps, micro caps. So your advice is take profits if you're doing it yourself and move to slightly larger larger companies and large caps in that sense. So is it possible we perhaps could look at, the most common argument which is thrown at anyone who says, well, maybe one should do that, or maybe we are in for a phase of consolidation or sideways market is, of course, there is a huge recency effect because every time people have called for it, markets have continued to run ahead. And this number two is, of course, liquidity, which is all real. If you get the numbers every month, it's just a big gush. So just your sense, Devina, what we should expect in that sense. Are we, is there going to be a time period where earnings will have to grow into prices, especially in the broader market?
Talking of liquidity, for one, I'm never a votary of that. If money comes, the market goes up. It doesn't show up that way. But more than that, if you look at the recent months and quarters, most of the money has come in certain themes, where it was small caps, it was defense funds, it was these kind of themes. And if you look at the history of thematic schemes from mutual funds, where the history is there for a long time, they always come near the peak of that cycle, which is not surprising because, after a segment has done well, whether it's an industry, whether it is small cap, whatever, is when the layperson knows about it. So they go and put money in that theme. But if that theme has to crash, it crashes. So, I remember last year someone told me that, ma'am, you keep talking about against thematic funds, but here is this technology fund, which was 2 rupees in 2003, and in 20 years it has compounded X times. And I said, very good. So it was 2 rupees in 2003. Did you see when it was launched? And it was launched exactly 1 week before the tech crash. So in 2 years, it had gone from 10 rupees to 2 rupees. And now you're telling me the compounding from 2 rupees. So be very wary of buying into any theme which has already run up, which is primarily all the new fund offerings that come are in themes which have already run up. So in 2021, I was warning same thing about NASDAQ ETFs and NASDAQ ETFs and funds being launched in India, saying this is also recency bias. NASDAQ has done brilliantly for 3 years. It won't last forever. And sure enough, it fell 40% from those peak. And some people compounded a bad buy with a bad sell by also selling at that 40% down. So be very wary of themes which have already run up, and do not fall for this that someone was telling me, but there will be a unlimited money chasing limited number of stocks. And I really laughed. I said, for 30 years, I have seen this argument. It never works. The stocks which were darlings and everybody was waiting to buy them still will crash if the fundamentals don't hold up.
Absolutely, absolutely. That's a fair point. Devina, always good speaking with you. Thank you for joining in. And tomorrow is a big day. It's the union budget. Hopefully, we'll speak to you post that as well to get your sense on how to approach the markets from here. But always good speaking to you and seeing you this morning. Thanks for joining in.
Thank you.
Okay, well, that's the word on the markets.